What's up, everybody? It's Jeremy here, host of the Tampa Bay Veteran Investor podcast, and have a recurring guest. First, I had the honor of being on his show. I wanted to bring you guys today, Jared, with Rain City Capital, good friend of ours, and we're going to be talking today about lending options for real estate investors. So, Jared, kick us off with whatever you'd like to share, man. Give the listeners a little bit of sneak peek of who you are, what you're up to, and we'll go from there.
Awesome, man. Well, always a pleasure to get to chat with you, and an even better bonus to do it in a way that we can share with others. So, uh, backdrop on me: I'm a real estate investor first, lender second. But you'd probably know me as a lender. So anything investment properties, rentals, fix and flip, ground up construction in the 1 to 4 unit space. I'm the go-to guy for that. With most of my business focused in Tampa Bay. Been in the business for a few years. Before that, wholesaling, been involved in the mobile home park space, syndication, short-term rental stuff. So I've seen a little bit of everything over the past couple of years.
Yeah, man, that's something that I appreciate. That it's not like a requirement that, like, as a property manager or like a realtor has to own properties or a lender has to own stuff. But I think it's helpful. Gives them context. They kind of know what they're, in your instance, like what your borrowers are going through. Because like if you're borrowing money as well for your own deals and stuff, it gives context, a little bit more credibility, and I think it gives you a better value input for your audience or your clients. There's some stuff that we have gotten exposure to on the management stuff where it's like, like my wife's architecture company or whatever it is, where maybe it's not super relevant for all the clients, but there's little tips and tricks that you learn from some of these other interactions that you're having that are, relatable to your clients. If they're, yeah, maybe they're just looking for a standard loan, but it's like, hey, there's also some other stuff that you can think about this, or we need a little bit of money for you guys to get qualified down payment. Like, have you thought about, structuring something with family member, bringing a little private capital into the deal? It gives you some extra, brownie points and being able to educate them on navigating the lending environment and getting deals done.
100%. What you don't want to be, in my opinion, in this space is like a walking term sheet. Like the only thing that you're good for is people tell me like, "What can you do for this?" And then you quote them something like, "All right, now I'm going to call up the next 3 people and see who comes back with the lowest." Like that's what you
Yeah.
don't want to be. What you do want to be in this space is someone who can come from like a consultative coaching space of being like, "Oh, dude, I flipped the house right down the street. Like, no, this
Yeah.
isn't a deal. Like, I can tell
Yep.
you exactly what this thing is going to sell for, or problem comes up. I will be able to solve that problem for you. That you can't put a price on that, or I have been very intentional about making my reputation known that if you come to me, I'll help you find deals that you otherwise wouldn't have gotten."
Yep.
That's how you want to be. And if you're looking for a lender, cheaper and better usually don't belong in the same sentence. I mean,
Yeah.
it's hard to get that through people's head, but I mean, I talked to a guy this week who wanted to go with somebody cheaper, and guess what? Like, lender ghosted him, and he lost 2 deals. So
Yeah.
I
Well, let's
hope
talk
that was
about
worth the
let's talk
cheapness.
about that because I want to touch on the difference for between like a direct lender and a broker. Because when we had done some years ago, we had done some light transactional funding for people, and we were brokering a little bit, only for a few months, and had a bunch of deals blow apart because it was I think right around COVID time or something.
Oh
And
yeah,
so, explain kind of the benefits of what you guys offer and kind of the difference between people, like the right questions to ask a lender, or like, are you a direct lender? Are you a broker? Pros and cons, like, because
yeah,
that matters when you're a week from closing. Now, like, if somebody's brokering, it's like, oh, there's all these new requirements that we need to close the loan. And you're like, I thought this was
right.
done, 30 days ago.
So at the surface, when somebody tells you, "Oh, I can get you funded for this," there are two groups of people. Their option number one is that they're what we call a direct lender, which means that they're typically either lending their own cash, or they're an employee of the company that will lend their own cash from their own bank account at closing. Um, so pros of direct lending is the people who are telling you yes are able to open up and read established guidelines top to bottom whenever they want, that says exactly what we will fund and what we won't fund. And if issues come up, they have direct access to talk to underwriters and be like, "Hey, this is why I feel good about this deal. Like, let's make a pathway forward to getting a deal funded." So Pros is that typically, if somebody is a good direct lender, they're going to be able to tell you with a very high degree of confidence if something can actually fund or not and at what pricing. So it's much less likely that you're going to run into issues of like, hey, you told me this, but now we're here and it ain't what you told me.
Yeah.
Um, so that's a pro. And, when you're going direct, there's one less mouth to feed. So you can get better pricing as well. Brokers are, if you came to me, Jeremy, and I would say the biggest pro to brokerage is that there's a wider box of they'll be able to take something that's unique. So not what we call like a fairway type of, oh, this is a 3-bed, 2-bath fix and flip with somebody who has good credit and has done 5 deals. Like everybody wants to lend on that. There's no mystery about if a lender
Mhm.
can fund. But when you bring me something like, hey, this deal is rural, my credit score is kind of messed up, or like I have a bankruptcy from 6 years ago, and the seller wants to stay in the house for 3 months after I buy it, like something that's like, whoa, this is
Mhm.
freaking weird, not a lot of people are going to like this. That's where coming to a broker who's going to say, hey, I'm matchmaker, I'm going to listen to what you tell me, identify as much as I can about the deal, about you. And I, from my reputation, a good broker should have reputation with at least 10 direct lenders, if not more. And they should be able to listen to what you're telling them and be like, oh, I know the place for you, and line you up and white glove service, take care of everything to get you some unique situation resolved. So that's where I would say like going brokerage is great. Fairway deal, it's like
Mhm.
there's no reason. Like you're paying somebody extra to turn around and probably not know all the docs that you need, probably not know the requirements. Like, do they need interior access or not? Well, a broker can't read the guidelines, so
Yeah.
they won't know until they ask someone else.
Yeah. I feel like most of the deals that we've done over the years is like, there were always a better experience, I think, with direct lender. Like there was just less hiccups, less delays on maybe closings, less last minute stuff that was popping up when it was broker stuff that we would experience with brokers stuff because it was just like everything was kind of changing. So it's just like I think it's good to source through the options. I think most people would probably be just happy if they found a good direct lender that does pretty much the products that they're needing. And I think overall they'd be happier with it. Just from what we've been doing. And so, I know you guys have a couple different like loan types and stuff. Walk us through kind of some of the common questions you would get asked. Does credit score matter? Bankruptcies matter. Like, how much are you underwriting the individual versus like the property or both, with how you guys start to look at, brand new buyer that's come to you or a borrower that hasn't done a deal with you yet, what's your screening questions on that 30-minute call?
Yeah, I mean, that's a great question. So I will say that people are extremely preconditioned to like conventional loan space because everybody's familiar with conventional loans. Most people will get at least one conventional loan by the time, well, in this America, maybe by the time they're 40, but in past generations, by the time someone's 30 years old, everyone has gone through the rigorous process of conventional. And
Mhm.
so hard money, generally speaking, is much less known. So people will bring this framework of conventional into, could I get hard money or not? So one mental hurdle that I often have to help people overcome is like, this is a lot easier than conventional. To make it really simple, if you have a good deal, we're already looking like a very high probability of getting this funded. Um, And so the conversation that I have with people is there's really only ever going to be 5 things that would disqualify you from hard money. So those things look like you don't have proof of permanent residency in the US. That's gonna bite you.
Mm.
I will tell you that not having a green card can make it really, really tough. I mean, look at our political environment right now. It's no mystery. Like
Mhm. Yeah.
ICE knocking on doors, it's like, well, we probably
Yeah.
don't want to lend if you are at high risk for that happening.
Yep.
Um, so that'd be number one. So if you have permanent residency, great. I don't like to really focus on saying credit score because score is not as relevant as the narrative. So, do you have a history of paying people back on time? If
Mhm.
you can say, yes, I do, that matters a lot more than what your specific credit score number is at.
Yeah.
So some people might just not have a lot of credit history and they have like one open credit card. It's like, all
Right.
right, we don't know much from that at all. Someone else might have like their credit score is like a 702, but we look and they've got several mortgage lates from the past couple of years. And it's like, hey,
Yeah.
your score looks good, but like, why are you? We know that you're not paying your lenders back on time, and we're a lender, so
Yeah.
not awesome. So that's number two. Can you prove to us that you have a history of paying people back on time? Number three is, does your track record suggest that you act with integrity, specifically when it comes to financial matters? In
Mhm.
other words, we take a look at your backgrounds. Some things that have come up in the past is like, um, people, what is it, grand larceny if you get caught shoplifting? That comes up, it's like, dude, that your track record says that you steal from people.
Yeah.
We don't want you to steal from us. So background specifically related to financial, I will tell you that if you have a felony, even from when you were 18 and it's expunged, it's extremely tough in the note
Mhm.
buyer market. So back end, what happens to these loans? They really, really don't like that. So that can make it really tough. Um,
That might be a good point just to kind of break down some of the even if you're a direct lender, like after you guys fund a loan, like, a lot of these, like, you buy a house, my mortgage has changed like 3 times, right? From like Lenard or whatever, whatever. And so some of the lenders are going to have to put some things into place to that make sure that, hey, if we want to hold this loan, great. If we want to sell it off the books to another bank or another, buyer of loans, that it's like, there's some sort of justification to get a decent amount for that loan, or they're going to have to maybe you'd have to sell the loan at a discount for them to take a risk on a more risky
right.
borrower. So that's like the secondary market that exists that people probably don't realize much
Yeah.
about.
We should talk about that. I'll wrap up the last kind of two questions that someone would ask, but it's a great point. It kind of comes down to managing your liquidity. If you run out of liquidity as a lender, you don't have a business,
Hmm.
which is true of most businesses, right? So background is going to be point number three. Uh, four question: do you have enough money to close? You'd be surprised. Like, I asked people that question, like, oh, actually, I don't. Okay, well, if you couldn't send your money into close and have a couple months worth of reserves, and on top of that, I don't feel confident that you actually have the ability to handle all the interest payments throughout,
Hmm.
front fund your renovation, and have an emergency fund for or some kind of solution for if when your reno budget runs over, because 80% of the time they do,
Yeah.
then no, you're not ready to go. Um, and then the last one is that you're not buying this to live in. As an individual, if you meet those 5 questions, pre-approved. Consider yourself good to go.
Get the gold slip. Yeah.
That's it, man. For I will tell you that if you haven't done a deal before, that's going to limit your scope of lenders that you can work with.
Yeah. Like
But
first time borrower and maybe
yeah,
like a little bit more strict on some of the stuff that you guys are looking for.
it
No
definitely
experience and
won't.
stuff.
It won't, like, you can still do a loan, like, you don't have to bring on a cosigner. I'll do those at 15% down. I work with a lot of newbies, but I wanna see that whoever you're getting guidance from, you're working with for the reno, et cetera, like, I wanna make sure that you win,
Yeah.
as any lender should. But those if you can pass those 5, you're good to go. You can start shopping, get yourself pre-approved, and get a proof of funds so people take your offers seriously, but that's it.
Yeah. Well, that's one thing that I think that people miss too is like lenders are a great person to have like like check a deal. Um, Due diligence that they're doing on the deal that they're going to lend on. If your property manager, your lender or something is not really interested or is sort of sketchy on the property, like that's probably a good idea. Like, hey, maybe this isn't a deal. So that's something that lenders can provide is some, hey, we've seen some other deals that looked like this. I think you're sort of maybe under analyzing how long it's going to take. If we funding a bunch of these loans and we have so much exposure to these borrowers, we might really push you towards a 12-month loan uh, versus 6. Or if you're doing a new build, maybe we need to look at an 18 versus 12 because permits are
Yep.
taking long based on this deal we just funded last month. So I think that's something that borrowers need to understand is like your lender can be such a great resource for understanding the current environment and like really looking at them as a partner to make sure you're buying good deals. Cause, through the different networking groups over the years, you see somebody do their first deal and they lose like their whole nest egg that they had saved up and like they're probably and they're 50, 60 years old and it's like dude that was probably like their one shot to like get something done half decent
Yep.
and then they disappear, they never come back. You're like you just probably assume that they maybe never do a deal again. It just blew apart
Yep.
their thing. So you got to be so careful. It's like it's good to look at the upside. I think it's much more important to look at what can go wrong.
Yeah, yeah. Don't focus too much on the upside. And you know what I will say? I think that I used to think that most of this, like wearing the rose-colored glasses going into a deal, believing what a wholesaler tells you about the upside on a deal or how cheap the reno will be. I used to think this was like a mostly newbie type of like, oh, if you're new, you really need to pay attention. But dude, I had someone, a borrower, I just posted about this on Facebook yesterday. This guy comes to me as someone who's highly experienced, at least 20 plus flips under his belt in the last couple of years and immediately went and bought 3 deals. Didn't didn't run the deals past me at all before locking them up. Submitted
Mm.
EMD and was like, "Hey, I know what I'm doing. You're just the lender. Just fund these for me."
Shut up and show me the money.
Exactly. And like, "Hey, look, you can run your business that way. If it's a good deal and you're qualified, like I can get you to the closing table. I don't want you to lose your EMD." However, while this person said with a high degree of confidence, like I'm going to do the reno for this amount and I'm going to sell it quickly at X ARV. Well, the results are one house is 100 days on market now with like 7 saves on Zillow, hasn't gone
Mhm.
pending. Another one, 60 days on market with like 14 saves, hasn't gone pending. Another one funded 6 months ago. The reno's not done, and this guy hasn't made interest payments for 2 months.
Dang,
And
man.
so, where I would have said, like, hey, did you do the reno for that amount? He probably did, but the reno sucks. Like, I
Right.
wouldn't
Yeah.
buy that house. No way, dude. That
Yeah.
like my forever home, it wouldn't be that piece of crap. Like,
Yeah.
so to your point, I think the relationship that you should be having with your lender is think of it this way. You're not only are you going to get funds from them, that's great. But as part of the service, you'll get an entire team with thousands and thousands of transactions of experience to review your deal. So loan officer is going to review it, and then an underwriting team is going to review it. And the whole point of it is trying to see if like it passes the poke test. Like where could
Mhm.
this deal possibly go wrong or blow up? And people get really upset if something comes back and we say no to a deal. Like,
Yeah.
dude, you should be grateful. Like, are you
Right.
kidding me? Five
Yeah.
grand EMV is nothing like losing 50K on a deal or not getting to the end of the deal. And like, you find out, oh, that illegal ADU turns out the
Yeah.
city of Tampa actually does really care about that. And people just think
Uh,
they won't.
yeah.
um,
It's it's such a
yeah,
good thing, man, because like so from a flip perspective, I think I had looked the last newsletter that we did that I think Seat Pete was down 9 to 10% over the last 12 months on single
yep,
home prices. Tampa was maybe like 7 or 8, not as drastic, but and it just keeps falling every month they run it. It's getting worse. And you guys have exposure to the appraisal market, kind of as you're seeing stuff comes back, or if you're doing BPOs or whatever. But like, values are starting to fall, right? And then on long-term rentals, long-term rental rates have fallen as well in most areas to some extent. We're filling new tenants that are paying less than tenants that are in the same building and that have been there for a while. And so there's also that like, oh yeah, like you got your ARV that you thought was 400. Like we had a deal that all day long, probably sold, if we were sold it a year ago, it would have been 400, and we got like 360. Appraisal was kind of rough, and we just had to take it. So it's also that piece of like, oh yeah, what about price if it doesn't work out, or if you're planning to flip it, but now you got to rent it like this 100 days on market. Like maybe he'd just be better off just sucking it up for 12 months, renting it out, and trying to sell it in a year. You know, always gotta have a
well,
plan B.
he won't be able to refi with late
Yeah.
payment. That
Well,
that
yeah.
actually that's one of the things that I see is, like, these people that go into, like, "I'm gonna burr it," and then they even one single late payment on your hard money can mess up your refi, and if that
Mm,
people will go into a burr and they'll just do a crappy reno because 'cause they're like, "I can rent this out,"
yeah.
and you think to yourself, "I have 2 exit strategies because 'cause I'm gonna go into this, I'm gonna burr it." But if you don't do your diligence throughout, miss one single payment, or you're late 30 days on one payment, all of a sudden you have to sell it. Like, no takeout lender is gonna bet on somebody who couldn't even make their hard money payment.
Yeah,
I'm not gonna marry you for 30 years. You
yeah.
already showed you don't wanna make payments on this property.
Even for, loan length, so I'd like to know, like, what you guys are seeing. I would assume most people that are doing flips right now, like, to me, it just makes more sense, even if it's a little bit more expensive to pay for, like, a 12-month loan. Let's say we're just doing a flip, right? Um, because you get it in 6 months, maybe you have to extend or something, but it's like, there's just stuff that's out of your
Yeah.
control, right? Storms, hurricanes, whatever, insurance you can't bind, contractor issues, right? It's like everybody's had them. So to me, I would think, and maybe you walk us through kind of what you're seeing, the more successful investors do, but I would think that, you know, 12 months to me just seems like an absolute no-brainer. Just have the more flexibility if something takes a little bit longer or, whatever it is. So we'd love to walk through what you're kind of seeing average around stuff for maybe down payments and points and kind of term lengths and stuff. And if you guys are doing much bridge stuff anymore, or if it's mostly kind of your traditional 12-month type stuff, at least if we're talking, flips at the
Yeah.
moment.
Um, so touching on term length first, I will tell you that I get surprised. We only do 12-month, which is pretty
Okay.
unique.
I
I
think
would
it's a
say
good thing because, like, it's not like you're trying to give them 6 points and 6 months and smoke them for 3 points to extend another 6 months. Like, I think it's a good, it's a small but important detail from a lender. Like, I think it shows that it's not about like the money. If they're not trying to be loan sharks and stuff. It's like they're
correct.
really looking, I think, at a good, like, maybe lender has a shorter option. Sure, that's fine. But it's like I think that's a good small like thing. That's like, all right, this lender's like, probably doing the right thing.
Yeah, if some lenders do really have a profit center in their extensions, it's not. We hate to extend, and we don't. Thankfully, that's not like a focus of where we're trying to make our money.
Yeah.
Loan officers do not get compensated on. Nobody makes extra money from extensions. I'll put it that way. There are no incentives that way. Um, but I am surprised by how many loans extend doing only 12-month terms. You would think, like, come on, bro. Nobody's gonna be into the deal for more than a year. In this market, with how things change, we were talking about data in Pinellas County and Tampa. Well, if people are generally speaking taking that 10% margin rule on a flip, and that's if things go well, and most people are too optimistic, then by the time you sell, you're down 8%. Like, your spread's gone. And if people are hurting, they're trying to, like, they're overlisting, hoping that they get lucky. Then
Yeah.
that bites them in the butt because now they're high days on market. Before you know it, like, you're 6 months on market and it took you 6 months to get the deal listed.
Hmm.
What happens pretty often. What I will tell you is that if you had asked me a year ago about term length, I would be like, you should never do less than 12 months. Unless it's like a wholesale, you're buying it and listing it the next day, never a reason. Doesn't make sense to me. However, the insurance market has changed so much in Florida that now it is one thing that I wish I could do is offer 6 months if it's a deal that I know somebody's gonna be able to list, like, immediately after closing. The
Mm.
reason being is you're familiar with the difference between earned and unearned insurance policies?
You can explain it.
Okay, so it's the same as refundable or non-refundable. They're like reverse. So earned means you get an insurance policy. Doesn't matter if you cancel it the next day, you're out that money. Like, it's gone. Light it on fire, which
Oh,
is
gotcha. Yeah.
what you do with an insurance policy anyways. At least it seems that way. I've only ever seen one client actually do something with their insurance policy on a fix and flip. So, um a year ago, I could get unearned for everything. Like, if somebody got an earned policy, I'd be like, "Bro, your agent sucks." Um, Now, if I see someone get approved in Tampa Bay for an unearned policy, I'm like, "Oh my god, this is amazing." Um, and so what sucks about it is that I will commonly see insurance policies on a fix and flip. Let's just say a loan size of 300K, which is pretty normal in Tampa Bay. Insurance could be 5 grand or more. I saw one come in this week that was 8 grand for a deal in St. Pete, non-flood
Dang,
zone.
man.
And so now all of a sudden, like, dude, 8 grand, that's like close to where you're gonna pay in total lender fees.
Right. Yeah.
And so the thing that's been really tough about Florida and why I think people need to be more conservative with their purchase price is, like, people are not they're underestimating their insurance costs. And while I do think you should go in for 12 months, you do need to consider realistically, you're probably going to end up with an earned insurance policy. And that's like not an insignificant, I tell people bank for at least 5 grand.
Mhm.
Um, and so when you're in instances where you know it's gonna be really quick in and out, and worst case scenario, you pay, a point for a 3-month extension, and you should be asking your lenders that because some lenders are much more aggressive on extensions. You really
Yeah.
shouldn't be paying more than a point for a 3-month extension in most cases. But it used to be an obvious take as long as you could within reason, and now it's become a little bit more nuanced for like, dude, insurance sucks. Like, I
Yeah.
you probably won't get refunded. So it is something to consider that makes it a little bit more difficult to answer than it used to be.
Yeah. And making sure like you're in and knowing the market for your end buyer, right? So if it's like a flip, you know, keeping an eye on the interest rates. Obviously the tax value is going to get reassessed. Um and and like you said, insurance costs, understanding what's the end buyer going to have to pay. And it just plays into the
Right.
affordability and the pricing because you might see, yeah, you might pull a comp from 6 months ago, 9 months ago. Um, but all that stuff needs to be looked at on from the exit to knowing like
Yeah,
how to go in at a good strike price, make sure you're gonna be able to sell it quickly.
dude.
Or even if it's just a rental, it's a rental play. It's like, yeah, I've seen some insurance policies come down in price, but it's been like, you should always assume insurance and taxes are just gonna keep going up. And so if the deal's really skinny, especially on the rental side, it's like, dude, maintenance isn't getting cheaper. Interest rates, yeah, maybe they come down a little bit or something. But it's like,
Rents aren't going up by
yeah,
double
rents are
digits
softening
anymore.
too on top of that, right? So before
Yeah.
the rent increases were hiding, maybe mistakes or maintenance and stuff. But now it's like, the labor markets, you can hardly get anybody out of bed for $100, you know,
Yep.
just to
Yeah.
take a trip charge to somewhere, on the rental stuff. So the cash flow, especially on the rental stuff, man, has just got to be really conservative on the maintenance and stuff. And, when it comes to running the performance on that stuff too.
Well, and if you want to talk about you right at the beginning of the show, I'd mentioned what you don't want is to talk to someone who's just a walking term sheet in terms of your lender. And a prime example would be like, let's talk about this. You're going into something as a burr and you're underwriting your numbers and it's a flood zone deal, which, I mean, if you're in Pinellas County, that's a third of deals. In Tampa, it's
Hmm.
probably more like a quarter. But what a lot of people wouldn't know is like, hey, you're going to get told what the flood policy is. But guess what? When you go to take it over from the seller, you're going to have a really hard time getting it reinstated for exactly 12 months or exactly 6 months. Guess what your hard money lender is going to require? They're going to want to see the flood policy matches the loan length. And so what that often means is then you have to get a new flood insurance policy, resets the premium standard, which is probably going to be way higher than what the
Hmm.
seller is paying. Now
Right.
you go to the back end to refi. Well, guess what? It's factored into your ratio. And now this could totally derail your plan all because of something you didn't know about, a technicality in insurance that you just wouldn't really be able to reasonably predict without being able to talk to someone who's highly experienced and knows specific to your area. These little things that could blow up a full deal because if you're banking on that insurance being at a certain price to hit your ratio, that's tough. Like you might have to
Yeah.
bring an extra 5 to 10% down.
Yeah. When it comes to like the rental loans you guys are doing for rental properties, what's kind of the debt service coverage ratio? Maybe walk through like just a basic level what that means for people. And, if they're calculating, like we're talking about rents falling and stuff like that, like how are you guys underwriting rental deals? Like assume somebody comes to you duplex, quad, or something that's already occupied, cash flowing. Like what are you guys kind of looking for, and what are you expecting them to set aside for, maintenance on a yearly basis, or are you requiring them to have a property manager or at least like buffer in some sort of management fee? Like, what are you walking them through to see if it's an actual rental deal that you guys are interested in funding?
Great question. Um, I'm gonna start kind of like high level so people understand the whys behind this and then go into specifically what that looks like. So here's some perspective on what we call this DSCR loan, which is a debt service coverage ratio loan, aka If rent pays for the property, we'll fund it. That's kind of like the thesis. Newer product. Prior to that, and this was before my time, my understanding is that mostly you had options to go get like a portfolio loan at a local bank, and they would only let you do so many. And so people would run into this challenge of if they had a lot of rental properties, like the money starts to run out. And so this product is newer. It's the DSCR space in terms of how many people are doing DSCRs is like blown up in the last 5 to 10 years. It's grown extremely quickly. It's provided a lot of new opportunities. And what tends to happen when in the lending space, when there's a new product, is that it'll grow, 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 grow. People are like opening their box. We'll lend on anything. We'll lend on anything. And then we see what happens in 2025 happen, which is that there was a bunch of fraud. People were buying these to owner occupy them. People were making up leases. People were in cahoots with appraisers. Like if you're trying to get a DSCR in Maryland, specifically Baltimore, good luck. There were particular areas that had a ton of fraud. And so this kind of brings into to circle back to your question, like what kind of ratios are we looking for? How do you know if it's a deal or not? I'll tell you right now, for most lenders, the box has shrunk a good bit to be like, hey, we want to see a property that is very clearly an investment property in an LLC. We're going to make sure that you got like we want to see it rented out. We don't want to lend on vacant properties. That's something that got harder to do after all the fraud from last year is being like, "Oh, well, let's use appraised rents." So we want to see that you've actually collected rent. We want to see a signed lease agreement. And in terms of the like what kind of ratio, this comes back to the thesis of if the rent pays for the loan, we like the deal. That makes sense. We feel good about that. So what comes part of debt servicing is principal, interest, taxes, and insurance. So taxes, in my experience, is based on the the most recent tax year. So like if you're
Okay.
buying from a seller who's owned the house for a long time, you can artificially make it look like you're going to cash flow for
Right.
the ratio, but in reality, like, huh, you might be down an extra $200 a month next year.
Yeah.
Um, so that's on taxes and on insurance, that's going to be based on a quote that you'll get during the process. So you go into this, you don't know what your rents are because even if you have the property rented out, you'll also get appraised rents, which can mess that up. So you go into it a little blind. You're not going to be certain what your rents are. You're not going to be certain what your insurance is. Taxes, you'll know, but you don't know what it's going to get reassessed for.
Right.
And then in terms of like, hey, like property manager, do we count that in the ratio? Do we count maintenance and these things? No. So like you could quote unquote ratio on, and lose $500 a month in practice when you're actually looking at depreciation of assets. In other words, like your maintenance or capex expense, vacancy for replacing tenants, or if you have tenants in place, what happens when they
Yeah.
vacate? You need to replace. For getting a property management team in there to make sure your asset actually performs. Those things aren't factored in. So, I mean, to be honest, most of the deals that I see will hit that 1x, what we call the 1x ratio, which is does your rent pay for debt service?
Right.
But I would never look at this and be like, "Oh, this thing cash flows." But,
Yeah.
typically, it's when something gets to around like a 1.2 ratio where I'm like, "Oh, this thing actually cash flows."
Yeah.
And you'll see for that reason, pricing starts to get better when you're above like that 1.15, 1.2. Depends on the lender. Everybody's got a little bit different. But the better it cash flows, the more someone has confidence that the deal
Yeah.
performs,
That makes sense.
lower risk, better terms.
Yeah. It makes a lot of sense. I think most of the time I'm like people, even if you're going to self manage or whatever, or it's like a brand new asset, it's like, man, at minimum, throw in that you're going to have just 10% for general maintenance. We're not even talking about doing a new roof or something or ACs when you buy it. 10% for maintenance. You probably can get cheaper, just ballpark 10% for property management, 5 to 10% for vacancy loss. If you have studios or one beds, you're going to have a lot more turnover over time than twos or threes, right? So it's like,
Yeah.
even if you just take 25% off the top before you even factoring in your debt service, right? To see if this thing's even going to make any money. And then you factor in, okay, like before, a lot of the performers would say, okay, maybe you're betting on a 1, 2, 3% rent increase every year. It's like I would just be ballparking for the next 18 months that your rents are flat or even 1 or 2% decline, you know. And so people just got to be really, really conservative on the rental side, I think, right now. But it makes
Dude,
sense that better cash flow, like better terms, and strategy. Um, how hard do you guys press into kind of like the experience or like you know their team, like the team that they have behind the borrower on like
so
the
for
overall
D
picture?
it's weird for what we call, like, RTL, what it's called in the space, residential transitionary loans. In other words, hard money, bridge loan, like these fix and flip purchase or ground up construction. The narrative is it like critical, like, hey, who are you working with? What are you going to do the property, etc. For DSCRs, it almost just feels like the narrative is still relevant, but it becomes so much more about like, did it appraise or not?
Hmm.
Um, and when it comes to experience, you see this huge, like, your experience really, really impacts the, like, this RTL hard money space. In DSCR, one of the, like, newer requirements that we've been seeing is most people wanna see that you, like, already have a different deal besides this, so we know this isn't a primary. Um,
Gotcha.
but it becomes like the appraisal and credit score starts to matter a lot. And beyond that, then the narrative of like, what does your team look like, et cetera. Personally, as an investor, I'm like, you better, there's no reason not to be working with the best. But in terms of loan approval, it starts
Yeah.
to matter a lot less for
Yeah.
whatever reason.
I've seen some like maybe more so in the 5+ unit like multifamily space um where some of that stuff I think may get looked at a little bit more, or like they want you to
Oh,
have
sure.
professional management or at least like ballparking for it too. And there's been some deals over time where clients buy something where like, yeah, we can like sign something with a lender or show them like a management agreement's in place. Like they might want to see something like that. But it's yeah, I mean it makes sense. I think that obviously the more experience somebody has, maybe the better terms and stuff that they get. But um from a fix and flip standpoint too, it's like, how do you guys when you're doing draws, can you maybe walk through draw process and how that works and sort of educate people on like, hey, if you're getting a hard money loan for the purchase price, but maybe you also want to factor in the rehab costs as part of the loan and maybe some things where people may not understand that with usually with the draw, you still need the money up front. You're getting reimbursed by the lender. So maybe walk through that sort of education piece when it comes to renovations.
Yeah, of course. And I will touch really quick on like 1 to 4 unit DSCR type of loan is completely different than 5 plus. The difference being 1 to 4, someone's like, they could probably pay the difference out of their pocket. Like,
Yeah.
we don't care as much about the type of team or the business plan. 5 plus unit, it's assumed that the asset absolutely has to pay for itself and it
Yeah.
absolutely has to perform, which makes it a completely different, night and day different. I mean, we don't even do 5 plus. Most of the
Yeah.
lenders that do 5 plus don't touch 1 to 4. Um,
Yep.
in terms of draws, we actually, I hosted a call just this week with the elite investor group on the art of the draw and how not to get screwed over. We'll circle right back to the start of the show again. This is where like going to that cheaper term sheet or who does higher leverage or who funds faster. This is where you start to see that a deal is not all about acquisition. That's half of it. The other half of your relationship with your lender is helping you successfully get to the end. And the draws become a huge piece of it. So to your point, yes, you probably to show liquidity to get approval, you probably don't need to show that you need any money set aside for the reno. It's a classic hard money line like, "Oh, we fund the entire renovation." Like you tell that to a newbie and they're like, "Great." And then you get into the deal, you're like, "All right, are you funding the renovation?" Like, "Yeah, yeah, after you pay for it first. We'll fund it 100% after you pay."
Yeah. Yeah.
Uh, asked me because that was the first time I got into a deal. I was like, "What do you guys mean?" I thought I was just funding 100%.
Where's that
I
credit
need
card I'm
more
supposed to
money?
swipe?
Oh my god, dude. My credit card limit's not that deep. So,
Oh, man.
yeah, there's just starting off, I tell people 4x rule for what kind of deal you can buy. So I had mentioned that people are really conditioned to conventional. Conventional, you get pre-approved for a specific amount that you can afford. Hard money doesn't work like that. Like it's not like, hey, you can buy this exact amount. Here's a letter that says you can buy this exact amount of deal.
Mhm.
But what I tell people is a good rule of thumb is take whatever funds you have set aside just for real estate investing. So let's say you have 100K, 4x that. So 100K, 4x is 400K. That's the max that you could afford and be in a good position for something in terms of deal cost. Deal cost being defined as purchase price plus reno. So if you brought me a deal that you were buying for 300K and it was 100K reno, be like, all right, I'm cool with that. I think you're going to be in a good spot. Anything more than that, you start to get really tight on funds. Um, so when we get into the actual draw process, you are going to front fund the reno. The best solution that I have is 0% interest business credit. That's what I personally use. I got 100 stacks out right now on 0% credit. For better or worse. It's crazy how comfortable you get with that after a while. But so being able to go in with credit cards, I go through a company called Fund and Grow local to Tampa Bay. That's a really good solution. You will pay credit card fees, but you get most of it back through spending promos and points, etc. So if you travel a lot, it is really the
Yeah.
closest I've ever found to free money. Like it is much cheaper than raising private capital,
Yep.
unless you're getting free private capital. Um, so that's one solution. The other is that you can come in with cash. You really should be in a position where you don't want to be taking draws all the time because they cost money. I mean, anywhere from $200 on the low end to 350 on the high end each time you take a draw. And by the way, just because you spent 30 grand doesn't mean that you'll get 30 grand back in your draw because contractor might have invoiced you for 30 grand. But when we look at that budget and scope that you filled out telling us what you were going to do to the property and how much you were going to spend on each line item. Well, that's what
Mhm.
we go off of for reimbursement. And that's what's commonly used across the industry. Just because you paid someone 30 grand doesn't mean that it shows up that 30 grand worth of work has been done.
Right. Or like, it's like 80% of the drywall is kind of there. His vendor's been a little slow, but you were still hoping to get the full thing.
Exactly. Yeah, exactly. And so draws the systems and practices, et cetera, vary enough across lenders that I won't just tell you, hey, here's the blanket that happens for all of them. I'll tell you, plan on waiting anywhere from like on the very, very quickest side, 2 business days from the time you request to draw with your lender to a slow lender could take 10 days. Um,
And
so
how
this
often are
way,
people sending somebody on site to even verify? Is that more of is that is that always happening with most lenders, or is it more does it depend on the scope where it's like, okay, some videos and photos may work? Like what's kind of common practice right now?
I would say that it's probably pretty 50-50 across the industry for sending inspectors versus photos. The problem with photos is that like let's just say I'm building 3 houses side by side and they're the same house. Even if I'm geo tracked, I can go into house one that's done, take pictures and like take them from slightly different
Oh yeah.
angles and then get like
You could
fully
definitely fake
drawn
it.
out. Yeah, so that's kind of like why most lenders don't love it. And then from somebody who's actually been on the other side of doing that process as well, you don't always know exactly what types of pictures need to be taken where to get reimbursed. So like I've had
Mm.
it where on my first loan I had that process, but they didn't like some of the pictures I took. And it was like a 45-minute drive out to my project. And I would have had to pay another fee to submit new photos. So it's just like
Oh.
whatever. Um, the company that I'm with, we do use inspectors, which if you have a good inspector, like I've got a borrower who also happens to be an inspector. I love it when he goes out to my projects. Because he is actually an investor and he knows. I've
Mhm.
had other, these are third party contracted inspectors who make like $100 to do these reports, right? I've had other people show up. I put in a brand new AC and they didn't take like they just credited 0% on it. And it's like, hey, here's the freaking receipt, man. It's a brand new AC unit. How in the world would you miss this? So
Yeah.
it's once again, if you've got a good loan officer, and preferably your lender is servicing their own note. They haven't um, paid a third party to service it. In other words, make sure the payments are going through, make sure draws are going through, like handle the customer service until completion. Um, that's something where you should be able to pick up the phone and get anything like that worked out and resolved quickly. So there are pros and cons to both, and nobody loves the draw process. Like I've
Yeah.
yet to talk to anybody who's like, "Oh, I always love draws. I've never had a single issue." Like if you're in the game enough, it will be an issue. So if you're going into deals not having a plan for not getting the draws that you want back, you're a fool. Like
Mhm.
this is part of managing your cash flow. And one of the things that I will tell you at some point in time, if you do enough deals, you'll have a draw that doesn't go the way that you want. So what's your plan of attack for it? Because if you're just going to
Yeah.
be upset about it with no tactical plan, then I'm sorry, you just haven't worked with lenders before. Like this is the
Yeah.
reality. Um,
And your projects, obviously, if you just have the ability to do your own funding on the repairs itself, it's like the project's gonna move a little bit quicker, right? If when you start to add up a couple draws, timelines, or if they don't like something and you're trying to like, well, I can't, I kinda need that to sort of get to the next step with the contractor. It's like it can just be kind of a unnecessary delay, I think, if you're able to
yeah.
prevent it. But
If I was to recommend my game plan to somebody, even somebody who doesn't have that much cash, I would say, hey, do your loan exactly as you would normally. Borrow the full reno amount because if you're with a non-Dutch lender, which most credible lenders at this point are, you won't get charged interest on the funds that you haven't been reimbursed for. Like take the loan the exact same way you would normally. But then when you go to renovate it, have a business line of credit, have 0% interest business credit, any other thing that's not your loan. I mean, this is assuming you don't have all the cash sitting on hand that you want to deploy as well. Use all of that. Like, and if you never have to touch the draw until you list the property in the MLS and send your lender a link to get reimbursed and pay off your credit lines or your credit cards, like do that.
a
That
little
would be
bit
what I
better
would
way.
recommend.
This is kinda how
Because
you have the safety net, but you're not having to use it. Yeah, I like that.
it's
Makes
insurance,
sense to me.
man. You're
Mhm.
paying, presumably 2% on, let's say, 100 grand. Okay, you're paying 2 grand to have guaranteed that you have 100K sitting there to reimburse yourself. Like that's pretty good risk management.
Yeah, yeah. Then I think that when you're talking about renovations, it's like it's so important to understand what not over improve the area, right? So whether you're going to sell the property or rent it out, you got to look at the comps. You have to really take a look at like what does this property really need and understand, especially on the rental side, most of what you're putting in, you're not getting out like you used to. So it's kind
Yeah.
of like a lot of our perspective right now is do as little as possible to make a unit decent shape because the ROI is not there on what you're putting in. And then from flip side or ground up, it's like when we talked about it at the Elite Investor Meetup, really considering definitely depending on price point, the finishes, hiring a private designer or someone with some sort of design experience, you know, to give you guidance on what's kind of trending, what would work in this area, what are the comps looking like? How did they do? Do we want to push the envelope on something? Do we want to, put in the extra money on higher finishes because we think it might move a little bit quicker? Or, you know, maybe it doesn't impact the price doing the nicer repairs, but we think that, hey, there's some other stuff on the market. It's not moving as fast, like just time value of money, right? If we can move it faster, but even if we sell it for the same price as the other guy, like this, that's still a benefit, right? So I think it's
Yeah.
important more now than ever, too, when you have values that are starting to fall or just a little bit shaky, like really putting some extra effort to like be thoughtful around, the layout of the property. If it's a new build, or if it's a renovation, like not trying to look like everybody else, but still keep it, in a general good design eye without doing something, doing stuff that's like real specific to only a small percentage of the buyers on like the types of finishes, whether you're going with gold or black or silver or whatever it is, you know, just putting some good thought into it. Like the couple grand you might spend on somebody that's like a designer or that can help you maybe save costs on some of the materials, but still get like high quality, I think is going to be is and gonna be continue to be, like, pretty important to do. I don't know if you have many borrows on the flip side that are doing that, like, some sort of outside person perspective on design, but to me, it
I'll
makes sense.
I'll take it a step further and say, if you're not doing that, what are you doing? One of the biggest kind of like I don't know, frustrations, I'll say, with people who get into fix and flip, etcetera. Here's the typical narrative. Hey, I have a good job. I've saved up money and I want to be an entrepreneur and I want to make money on my own pace. I want to call the shots. I want to get into fix and flip. They get into fix and flip. And then lo and behold, you find out that they have this job where they're making $80 an hour, $100 an hour, $50 an hour. And they start doing these tasks that they're not good at. They have no experience in. And it's probably a $20 per hour task. And I'm like, hey, are you trying to be self employed or are you trying to be an entrepreneur? Because what you should be doing as a fix and flipper is not swinging hammers. You should be recognizing opportunities for profit and coordinating. That's what you do as
Mhm.
an entrepreneur. You recognize an opportunity and you coordinate. You hire the people to do the things. You optimize the capital, you recognize the opportunity, you are a coordinator. So if you want to be an entrepreneur, what you do is you assemble your team, whether that is a lender, whether that is a property manager, whether that is an asset manager, whether that is a designer, whether that's a project manager, whether that's a GC. And if you do the deals the right way, in my opinion, right, what I would call right, and the way that
Yeah.
I try to operate, dude, I don't want to see my houses. I want to see the checks in the bank. Like,
Yeah.
I don't wanna go show up and, like, spend time inspecting work or doing or be at Home Depot, like, the 2 of the flips I have going right now, I've, like, hardly ever seen them. I've seen both of the houses 1 time, ever.
Yeah.
Amazing, dude, like, you know what I am doing? Managing emails, keeping people accountable, keeping track of capital, like, I'm being an entrepreneur, so, I think if you want to be an entrepreneur, you need to recognize opportunities that are good enough opportunities that you can hire people who are better than you, who already have systems and experience, and still make the money that you want to. And if your deals aren't hitting that, they're not deals. And that's where you're
Mhm.
getting messed up.
Yeah, and it's we're all gonna be, like, wanting to put in the ceiling fans or the chandelier that, like, we like, and it's like, "Dude, nobody cares what you what you want."
Not your
And
house.
I would yeah, I
Not
would
your
be
house.
scared that, like, subconsciously, I'm trying to do the most objective thing of, like, what's gonna be most appealing, but even then, you're still gonna be somewhat, I think, natural to put in something that you think,
Yeah.
looks good, where it's like you need somebody that, whether you're touring, new builds that are going on from different builders, like either communities or just like other guys in the marketplace, like Viking or Domain, you're sort of walking through what are they doing, maybe keep an eye on things, but it's like, you know, that's a simple thing where it's like, oh, how hard is it just to pick the paint? We'll pick something like, oh, we'll just pick white or whatever. And like, white cabinets and black handles, but it's like you wanna have somebody that actually has perspective on the current market with that stuff and what's gonna most appeal to the buyers in your price point, or from a rental standpoint, like knowing if you're over improving because you have a vision for the property, or if you're like, "Hey, I'm just literally trying to get somebody to move into this apartment to pay some rent." Totally
Yeah.
different perspective, but get some outside input just like you said.
I think in my experience when I like doing projects, etc., it's very common for like whether it's contractors, designers, etc., to start asking you questions as a person paying the bill, like, do you like this? I think the way that you answer that question is doesn't matter. It's not my house. I'm not going to live here. You know who we want to live here as a renter or a buyer. What do you like? Do you think they would like it? Because whatever you think that they would like as the expert, that's what we should do as long as it's
Yeah.
cost effective and makes sense with our business strategy. Doesn't matter. I mean, I could think the house is the ugliest thing in the world, but if it's the perfect house for the type of person that I want to move into it, let's make it look like that. Like,
Mhm.
what? It's not my house. I'm not living in it. Like,
Yeah.
maybe tenants think this is the worst thing ever, so I wouldn't put this in a rental property, like, this is my house, I want this house to look the way that I
Yeah.
want it to, but it's an
Yeah.
investment, it's not my house.
Yeah. Yeah, like, just the other day, I was walking a property with the owner, he's like, "Oh, what do you think about paint for the outside?" I was like, "Oh, I've seen like, this might look good, or this matches the logo or brand of the building or something, maybe we could do something this route," but it's like, dude, for the asset size, you just pay if you paid some local designer to come up, and it's a little bit easier with the way AI and stuff's developed to kinda brainstorm,
Mm,
maybe throw some photos in and, like, get some ideas and play with some stuff, so I think that's, probably a blessing and a curse for some people, um, but it's like there's such a big, ROI, especially when you're talking about bigger price points, bigger deals, to just get some outside perspective on what the market is doing versus just Oh, I think this looks good. Or we've been using the same red door on on the rentals, dude, for like, 15 years. Like, all right, that's probably not a good thing to keep doing. But
That's funny. On my rental, there was, like, this freaking red door, dude. There wasn't even a deadbolt. It was just, like, a red door with no window, like, no, just a freaking blank slate, like a plank.
oh yeah,
I was like, "Alright, that is definitely going because that screams 1980s rental, and
yeah,
no, I know for sure whoever wants to live there doesn't want to walk into that door every day."
yeah, yeah. And it could really transform me. Even on my own house, the door was like a maroon when we bought the property, and we went black with the gold on the front door, and dude, just transforms the whole entry. So,
Yeah,
and that's the small stuff. That's where the experience of a good lender, property manager, whatever it is, like, has an eye for, like, let's put in the right amount of money, but not over improve, but, like, let's make smart decisions on what we wanna do here,
yeah,
like, not go crazy with the budgets, and especially when you have material costs increasing, the labor pool is always kinda tough in construction. You have to kinda be just really thoughtful about what we're putting in and what we're spending our money on, and that's gonna achieve the goal that you guys are looking for. Because for flips, it's how quickly are you gonna get that sale, get it under contract, good quality so that the inspection goes well. And the rental standpoint, it's like days on market, man. It's like hardest leasing market in years, and so it's like you just gotta nail it from the front end and be really
yeah,
good and thoughtful on the quality and what you're doing with it, and not trying to over improve because it's like it's tough now for owners. They're not getting them. Like you're having to update to keep the you're having to spend money to update to keep the rents where they're at. So you're
right.
investing to keep rents from not falling. You're not
It's
even getting an
crazy.
increase. You're just like trying to protect the downside.
You know what is crazy is so on my rental, I have experience with only one. But I was like, "Yeah, dude, I'm paying $150 to get, like, the most professional quality pictures I possibly can." Like, dude, I'm gonna do everything to optimize this listing because I was going into winter. I know it's tough. Plus, I spend
Yeah,
$150 on pictures. My holding cost per day is, like, half of that. So this is 2
yeah,
days of holding costs worth of pictures. But when I go into the rental space, dude, the whole, like, iPhone pictures, like, not even showing the
crazy.
property, the listing description sucks. I'm like, you in this market, I feel like if you're not treating listings to the same quality, borderline as a fix and flip, what are you doing? Like, that is
Yeah,
one of the easiest ways
dude.
I think
I
to
was
do that.
running comps yesterday and I saw like a yeah duplex had just outside photos. And I'm like, how are you
Who would
ever
rent
gonna
that?
rent this thing, dude? And this is brutal. But on top of that, it's like professional photos. Um, our photographer now does video walkthroughs, so to be literally like he's
Ooh,
holding a camera through the whole thing, gets uploaded to YouTube. So it helps for so if you have out of area buyers that are going to buy your house, or out of town renters that are maybe moving to the area, video stuff with sometimes we like doing the drone stuff too. But it's like all those little steps, and then also he'll virtually stage all of them, so we'll have both like
dang.
staged and unstaged photos they can kind of see. And so like we're in a couple $100 off the rip just for, nice photos, but it's dude, God, it matters so much, man. Price is everything. If it's good quality, it's like presentation solid, you have a good description. That's like there's nothing else causing an issue than price. You just know it's all right, chop the price if you're not getting what you want.
It's a
If you've done
signal
all those
for
steps, you know that you've given it the best effort to sell or rent quickly.
right, and if you're somebody who's renting, it's a very strong signal to the type of experience that you're gonna get. Like, you think the outside
Yeah.
duplex photos, you're gonna, like, have a water leak and that's getting fixed same day? Yeah, right, bro.
Yeah.
No way.
Yeah, that's part of it is, like, when we're walking like, went to a property yesterday, owner wants us to take over a house, and, it's like, "Man, we need to do some landscape cleanup, there's some fence panels falling, like, we need to pressure wash this, like, the wood around the porch, around the front of the house, because it's like a 3-1 in East Tampa, it's like, "Do we need
Sure.
to the $200 you're gonna pay to just repaint this whole little deck thing is amazing." The wood's not in great shape, but you paint it, not as noticeable. There's so many things that, at least on the rental side, having a good eye for that stuff is so important, man. Just the mailbox is teetering over. Dude, spend the $300, get a new post with a nice new mailbox, new stickers. You're like, what are we doing here? It's so important just to get that right on the front end.
100%.
Cool, man. Any final thoughts for us today? I know we're actually coming up on about an hour. Let's maybe before we has there already been maybe one of the last things. has there been any major shifts, let's say last 12 months or that you're thinking in the next 12 months from the hard money lending space, whether it's requirements or, just anything that you guys are it could be specific to your guys' company or just something that you're starting to see move in the marketplace, from a lending perspective that you'd like to share?
Yeah, I'll say the biggest thing that I've seen change, particularly 2025 was a bad year for most pretty much every hard money lending company. There were several that went totally under. Tampa Bay wasn't the only place to go down this year. So you had overall a reduction in volume, a reduction in prices. So hard money, I think, as like an industry, extremely profitable for most of the 2010s. Extremely profitable. This like the last 2 years, and I think 2026 is going to be more of the same, has been the first time that a lot of these companies really got shook up. And so what I've been seeing is just lenders getting more aggressive. Like people have to take market share now to continue to get the profits or the type of business and growth that they wanted to. And so what I'm seeing is increased leverage, rates going down. I mean, our rates went down a full interest, a full 1%
So better
in
for
interest.
borrowers, basically.
Yeah, like it's getting better for borrowers. It's a double-edged sword because as leverages increase, as requirements drop, etc. Well, the other thing that's pretty likely to happen is defaults going up.
Mhm.
And so right now, like I have seen more movement in price in the last 6 months on hard money in terms of leverage, in terms of rates, etc., in favor of investors. But also, I see like the percentage of people defaulting on hard money is
Yeah,
considerably higher than it was a few years ago.
yeah. Yeah, I think it's a mix probably, just like lot more lax maybe guidelines, but also like people just not anticipating the value changes and, appraisals, they are what they are, man. Like you can have all the comps, but you might just get one that sucks. And so it's like all that
Right.
stuff just continues to impact the deals and or how quick you can get out of it or, you know, if you're gonna wait for the next buyer, wait another 60 days to get somebody else or just take the cash on the front end. So that's helpful.
Yep.
It's good to know. I think it's, just like deals are, continue to be tough to come by. We have not seen a lot of rental deals cash flow, obviously, unless like somebody's paying cash or putting like, I hate that people have to put down like 40 to 50% for a deal to make sense when it's like, it should work it should work. Even if you're going to put that down, it should work at like the minimum. Let's say whatever it is, 25%, 30% for something for
Yeah.
commercial, to make the deal work. It's like the rental environment's pretty challenging, to just buy stuff that cash flows day one. It's definitely a little bit more challenging, but I know a lot of people are looking for deals, especially if the flips too, be kind of, you know, cautious. And I think that's been pushing a lot of people into trying to do maybe even new builds as a strategy over the last few years
Yeah.
versus like hard to find flips. Like, okay, maybe there's less competition or just that's a whole nother ball game
Or
too. New construction is so
yeah.
different.
Or even build to rent. It's gotten a lot
Yeah.
more popular.
Yeah.
Same reason.
Yeah, I'm just such a big fan of newer assets, better quality residents, like paying a higher price. Like, there's sort of that draw or has been that draw of like, oh, buy somewhere where, if you have to buy the cheapest duplex you can find to get your feet in, maybe it's a thing. But it's like after doing this for so long, I'm like, dude, if you could just find a way to buy a duplex for 400 instead of 250, which I don't know, 250 hardly even exists anymore, but it's like the
Right.
quality of residence is going to go up all that extra money you thought you were going to make on like a 10 cap or whatever. It's like, dude, just buy lower cap rate, better quality resident, newer property. You know,
Buy
I
good
love,
assets.
I love buying a new house for our primary that we bought because it's just like, you got brand new everything, dude. Like, you know, everything's brand new. So I think over the long term, like half my street was bought by like Progress Residential and stuff like that. So it's like 50 houses on my subdivision or they all, just got bought by institutions when they were built. And it's like over the long term, when you factor everything in, you're probably better just spending more for like sort of a crappier return now, maybe over the long term, because you'll save that up in maintenance and stuff in the long term. Buying better assets, better areas, trading up. If you're, if you're, and just evaluating like on the rental side, if your opportunity costs like maybe you got 100, like I have a client that only owes 80 grand on a property that's probably worth like, 300. And it's like, dude, he's like still like barely breaking even because insurance taxes. Like, you gotta look at like,
Shit.
can we repurpose this thing, sell this nonsense, get into something else, or just put it in the market for 12 months and just wait and see. It's like always evaluating, is this the best use of our capital? Equity
Yep.
stuck in deals, right? Or getting at least like an investment HELOC or like something to get something else or trade up into a better area. Get out of
Yep.
single family, buy a duplex for the same price. Just get into two doors versus one.
Yep.
Always kind of analyzing that stuff. But going on a rant here.
All good, man. As we do.
But how can best way for people to find you, reach out to you?
Yeah, best way to get a hold of me is through Instagram. So we got my handle there. It's Jared Does Hard Money. That's where I spend most of my time. Facebook is a good place to reach me as well. If you click through links on my Instagram, you'll be able to grab all my contact information, etc. If you want deals, I put out deals in Tampa Bay from trusted wholesalers and agents every single Wednesday. It's anywhere from 20 to 40 deals a week, so no shortage of them. Um, but
Where, in
that's
what states do you guys live in? Final thing, or
so
markets that you like to
we
live.
have a map. We have a map on our website, but I will tell you, if it's an investor friendly state, we're there. If it's
Okay, cool.
not, Northeast, like California, we're not in yet.
Yeah,
Like Nevada, yeah, we're not there.
a lot of southeast stuff.
Yeah,
Yeah,
southeast, Pacific Northwest, most of the Midwest, most of the South.
cool. Yeah, it's good, man. It's such an important thing. Landlord friendly, real estate friendly. So cool, man. Well, I appreciate you coming on the show. Any last thoughts before we end for the day?
No, man, that's it. Buy
Well,
good deals.
appreciate you coming in.
Good assets only.
Go out there, make some money, make it rain.
Sounds good, bro. Thanks for having me
All right,
on.
thanks, Jared. We'll see you.
All right, peace.